Ladies and gentlemen, thank you for standing by, and welcome to the Austbrokers full year results communication. At this time, all participants will be in a listen-only mode. There'll be a presentation followed by a question and answer session, at which time, if you do wish to queue for a question, you'll need to press 0 followed by 1 on your telephone. Please also note this conference is being recorded today, Thursday the 27th of August 2015. I would now like to hand the conference over to your host today, Mr. Mark Sells, CEO. Thank you, sir. Please go ahead.
Thank you very much, and good morning, everyone, and thank you for taking the time to attend our webcast today. I'd like to introduce Jodie Blackledge, our new Group CFO, and welcome her to her first Austbrokers results presentation, and also to take this opportunity of acknowledging the enormous contribution of our exiting CFO, Steve Roubre, who's with us today as well, and who many of you will be meeting again shortly in the one-to-one presentations. Today, Jodie and I will walk through the pack and open questions, as we said, at the end. Now, let me start by saying that in the face of a challenging commercial lines insurance market, we have delivered a solid set of results with good performance across our underlying organic growth drivers. We have continued the tradition of delivering consecutive year-on-year profit growth since listing. Importantly, given market conditions, FY15 was a year of delivering on our strategy, staying focused on our business model, and demonstrating great discipline in our approach to partnership and our operating model. Let me give you a snapshot of the financials, which Jodie will elaborate further on. As mentioned, we continue to deliver continuous growth with year-on-year growth since listing. Our adjusted NPAT was up 2.5% on previous year. That positions us in the middle of our guidance range and above consensus forecast. We announced today that the dividend has been increased over last year of 3.1%, now making up 39.7 cents, an increase of 3.1%. This means that at last night's closing price, the dividend yield fully franked was 5%. Despite the challenging market environment, group revenue increased 9.4%, and we have maintained our discipline with regard to internal investment and expense control, with the group cost-to-income ratio held beneath the rolling 7-year average at 18.9%. Translating the figures into key areas of execution, if we could turn over the page. As previously mentioned, a pleasing highlight this year has been the performance of our underlying organic growth drivers. This is a key area of focus for us. However, other factors have helped support growth this year and also provide a platform for future growth. Firstly, with respect to acquisitions. Our acquisitions are building a solid platform. Costs for these, as we know, are taken within the year. But in FY15, it was the biggest year to date for acquisitions, with over 70 million committed across the group. An area that we've been focused on is new markets and new business areas. And I'd like to spend a little while just talking about New Zealand, but elaborate further a little bit later on. We previously highlighted the successful execution of our plans to become a leading broker and risk solutions company in New Zealand. And we're pleased to report we are now the manager of the largest cluster group in New Zealand, which has now made us the third largest broking group by gross written premium, under a new brand, NZ Brokers. A little bit more about that later on. Our new business area, risk services, is already contributing to the group with over $2 million of net profit before tax in FY15. But more importantly, this sets the platform for future growth with excellent collaboration between broking, underwriting and insurer partners already delivering results. A key dimension of our plan, which I'll talk about later on, has been the income diversification over the last 2 or so years. If we go back to FY12, 12% of our business, of our profit was derived from non-broking businesses. The year just gone, that is now up to 23%. Our business model is demonstrating true resilience. Despite the negative premium rate environment that we already foreshadowed at the half year and was subsequently validated by the APRA GI stats and insurer data, our broking income performance has performed better than the market indicators. One of the key things within that is policy count and new client numbers. And effectively, as we have grown those, this positions us well for the future. Equally, the growth in our premium pool of over 20% provides good growth potential for the future. Over the page. I would like to spend a couple of minutes reminding the audience as to our enduring strategic vision and goal. Our ambition is to be the leading provider of risk management, advice and solutions to our clients working with our partners. Our client base is predominantly SME and mid-market businesses, and we want to be their partner of choice for all their risk needs, which include physical, financial and people-related risks. Over the page, we enable our strategy through the delivery of our operating model and supported by our owner-driver business model. Our operating model provides an additional benefit of helping diversify our profit generation, as each business area has to financially stand on its own 2 feet. We then go over the page. Whilst being focused on our strategy, we are also focused on the delivery of long-term sustainable growth. This is enabled by, firstly, a disciplined approach, and secondly, appropriate investment in our business areas that in turn assists our income mix. We go over the page. Clearly, we need to be able to measure the performance of our execution, and it's pleasing to see that in such a soft insurance market, we are experiencing good progress. From a disciplined focus perspective and from a broking perspective, we have seen, as I said before, solid underlying performance with growth in broker commission and fees, client numbers, premium funding and profit commissions. In underwriting, our profit commission performance is testament to the quality of our underwriting and strength of insurer partnerships. From an income diversification point of view, as previously stated, we're seeing a greater profit contribution now coming from non-broking sources. And from the growth in the network, both from an equity point of view and our network additions, this growth in our relationships is also testament to our very strong value propositions. Over the page, I would quickly like to provide some insights into the drivers of our business areas during FY15. And firstly, let's touch on broking. I've already talked about the resilience that we have with our business model and how that particularly applies to the broking area. With respect, however, to commission and fees, the heading there, importantly, our commission and fees during the year are up 3.1%, and that included strong contributions from other areas outside of commission. For example, our life income being up 3.9%, profit commissions up 5.4%, and importantly, premium funding was up 0.8%, which doesn't sound a lot, but in the context of the market was an extremely good result. And as I said before, our client count is up 4.9%. We've also had, at the corporate level, a good focus on expense control. But unlike a corporate model where we work in partnership with our broker partners, standing shoulder to shoulder with them, sitting on their boards, providing support, services and assistance. It was pleasing to see a real focus by our partners on expense control, especially given the fact they are serving more clients in a declining premium rate environment. Another real highlight from my point of view was the increasing level of collaboration between our broking partners and our risk service partners. This is benefiting our clients, the broker with stickier relationships with the clients, and the risk service business themselves by bringing in new clients to them. If we move on to over the page on the underwriting agencies, we've seen excellent performance over FY15. Revenue is increased by 29% and net profit before tax 35%. I'd like to point out here this is predominantly driven through organic growth. A particularly pleasing aspect has been that our startups are performing really well. Startup success now is contributing 25% to the agency's net profit before tax. And this is a good way of utilizing shareholder capital. Our technology enablement. We've invested heavily in the development of our product platform to improve ease of use, create back-office synergies, and improve speed of delivery. Our Shura 360 product is testament to this and has really helped our Latitude business on its growth path. In terms of leverage within our insurance partners, during the year we've taken the opportunity to negotiate long-term contracts in selected areas that will improve ongoing remuneration. Equally, testament to the strength of those insurer partners and the quality of underwriting is the fact that our profit commissions increased by 34%. From an investment in people and brand perspective, given the level of growth we've seen over the previous few years, we have invested in the bench strength of the organisation, bringing in new senior management to assist us on our growth path going forward. And as we make a note there in the last box, we continue to invest in improving operational efficiencies. And our offshoring plans came to reality this year. We've commenced in India, focusing on policy administration and analytics. Moving on to risk services over the page. As we've already highlighted, we've seen strong growth throughout the year. The division is now delivering over $2 million of net profit before tax to the group, and that is growing. We've also seen the addition of 2 new partners through the year, and since the year-end closed, we brought on a 4th partner, Allied Health Group. We often get asked about margins in this area, and I can confirm that this segment is delivering margins relatively higher than the traditional broking segment. I've already talked about the increasing collaboration with our broking businesses, but I'd like to talk a little bit about how we leverage group-wide insurer partners. And our strong relationships with our top 5 strategic insurer partners is testament to this. And a final point here, clearly, as we've invested heavily in group services over the years, the ability now is to apply those group services to our risk services partners to help improve their operational efficiency. And that already started during the previous financial year. If we come on to group services, remembering that basically we support all our operating businesses at cost with our group services, where the partner agrees it makes sense to do so. Critically, our technology continues to underpin our propositions. The iClose placement work is now complete, our side of the fence, and the iClose platform has been successfully deployed into selected underwriting agencies. 80% of our partners are using our data center capabilities, and we undertook a significant upgrade of core systems during the year to ensure we can meet the challenges, things like cybercrime, to improve our disaster recovery capabilities. We've had a real focus on people at a group level as well. Jodie, who's with me now, has joined the group. We've already seen a very smooth transition between Steve and herself. We also appointed a new group legal counsel role to help defray the growing external costs that the group faces. We continue to build group competencies, but basically we build these within the parameters of our cost-income ratio to ensure we have discipline around this. We've continually invested in marketing, HR, back office, risk and compliance, partner development, project management, and legal. We've also been investing in our new business and sales capabilities, deploying the group-wide CRM system, which is progressing ahead of plan. And this will assist in future sales and business growth activities. Finally, if we look at New Zealand, as I said before, we've now become the 3rd largest broking group in New Zealand, in excess of $500 million worth of gross written premium. During the year, we acquired 50% of New Zealand's largest independent broking company. We acquired the management rights to the group's largest cluster group, and since that time, we've actually merged in with the 2nd largest cluster group to become the largest cluster group in New Zealand. What this basically does for us as well is to create a pipeline of future owner-driver opportunities. Increasingly, we're seeing now the New Zealand colleagues leveraging group experience. In fact, we've had parties come over looking at how they can leverage a number of group services, and we will expect to see those implemented over the coming years. We've launched the NZ Brokers brand, and we're already seeing in the last financial year, FY15, good contribution of over $1 million net profit before tax, contributing to the group result, and this will grow over time. So those are the highlights. I'm now going to pass to Jodie to take us through the key financials.
Thank you, Mark, and hello to everyone. I'm going to take you through a more detailed look at the numbers. I'll cover an explanation of the adjustments to net profit after tax, makeup of divisional results, costs, balance sheet and funding. So firstly, if I can turn to page 14, a snapshot of the results as presented in our annual report. Mark has talked to these, so I'll be brief on this page. Adjusted net profit after tax increased to 36.3 million, continuing the trend of year-on-year growth since listing. Earnings per share is slightly down, impacted by share issues in a low-growth environment. The final dividend per share of 27.7 cents brings our full-year dividend to 39.7 cents, up 3.1% on the last year, and our cost-to-income ratio, as Marcus said, has been retained below the 7-year rolling average. On slide 15, I've summarised the reported net profit after tax per our statutory accounts, which provides an accounting consolidated view. If you're familiar with our model, you'll know that this is impacted by the way we need to account for our investments, controlled and associates. Our reported net profit after tax of 34.9 million is up 0.7% on the prior year. Consolidated revenues of 217 million in the current financial year, up 9.4% from the prior year. And this includes revenues from consolidated controlled entities and net profit from our associates, which is net of income tax and amortisation. In addition, there are a number of accounting profits and losses from changes in our shareholdings and carrying value of investments and intangibles, which impact the results. We therefore provide additional information to assist understand the underlying performance of the business. And if you turn to slide 16, that's the reconciliation. So this is a reconciliation of the group's reported net profit after tax of 34.9 million to what we refer to as adjusted net profit after tax of 36.3 million, which reflects that underlying performance. The table shows a view of tax after tax and after non-controlling interests, and you'll see similar numbers in our annual report. The first adjustment relates to accounting treatment of changes in estimations of contingent consideration and an offsetting reduction in the carrying value of the investments that these relate to, which is called an accounting impairment. The net impact of these accounting entries is a small profit. As you're aware, our model is to acquire businesses with deferred contingent consideration, and this consideration is based on stretch earnings growth assumptions to a capped amount and generally includes a fall. That's a reduction in price if the earnings performance declines. And this structure provides an incentive for future growth as well as ensuring that we don't overpay. The future contingent payments are structured in a way to ensure hurdle rates are met on future payments. The current environment has stress tested this model, and in the current year there's been a handful of investments with contingent consideration payments due in the next 12 months where we've revised our estimates of what we'll need to pay downwards, creating an accounting profit. At the same time, in what we consider to be a prudent approach, we've reduced the carrying value of those investments, causing an offsetting loss or impairment. Both of these items are included in reported net profit after tax, and we remove them when showing the adjusted net profit after tax. In relation to one of our investments in associates, we've recorded an impairment charge of 1.5 million. This is due to a specific competitive circumstances in a niche segment of the market. This impairment represents approximately 0.4% of the group's investment in associates and controlled entities. We take a careful approach to our impairment review process. In the current year, the long-term growth rate we have used is 2%, with a lower assumption in the stress test for all investments. In the current financial year, we've also earned profits from sale and deconsolidation of controlled entities of 0.8 million and a fair value adjustment of 3.2 million, and these have been reversed out for the adjusted net profit after tax. In addition, we have backed out the amortisation expense on intangibles, which is a non-cash item. After removing these items from our reported profit, our adjusted profit has increased by 2.5% to 36.3 million, in the middle of our guidance range and above consensus forecasts. Page 17, as Mark has already covered, the benefits of the group's diversification approach is demonstrated in the current year's results, with strong contribution from risk services and underwriting agencies, which offsets the reduced income from broking. Broking profit in Australia and New Zealand was down 4%, and that would have been down 6.7% before standalone acquisitions. On the following page, page 18, we represent the numbers on a 100% view. There's more detail on this in the appendices. So this is all of our holdings, whether they're controlled or associates, and it's before non-controlling interests. So while commissions and fees have been impacted by the soft market, there's been growth in our profit commissions, life and premium funding. Overall broker growth is down only 1% in a market where premium rates have been more significantly impacted. As flagged in the first half result, the contribution in the second half has been stronger, benefiting from the deferred renewal dates and profits from acquisitions. Premium funding income is up due to increased penetration rates despite reductions in premiums. On slide 19, the margins in broking have decreased in an environment of pressure on broking income in the current year. Before standalone acquisitions, commissions and fees were down 1.1% and expenses up 2.1%. As you know, our network of businesses are also acquisitive and have undertaken bolt-on acquisitions which contribute to cost growth, so real cost growth is less than this. The network has incurred costs in servicing an increased client and policy count. So client numbers are up 4.9%, policy count 4.5%. And I think pleasingly, the margins have improved from the first half 15, where they were 24.4%, to the full year margin of 28.2%. The next slide, we move on to underwriting agencies. This business has delivered 35% profit growth to $13.2 million. And pleasingly, circa 25% of this profit before tax was generated from startup agencies seeded in the last 3 years. Profit commissions were up, reflecting the continued underwriting of profitable business. Commission and fee incomes increased 29%, benefiting from securing long-term contracts with key insurers on improved terms. That's improved commissions, improved underwriting profit share, and additional fees for the current year and the future. These contracts reflect the value of the business model we developed and our relationship with insurers. Expenses reflect increased resources to keep pace with growth and costs in relation to acquisitions. The costs in the second half were flat on the first half. I think we mentioned there were some operational benefits from spend in the first half which have come through the second half, and then that's offset by the continued growth in some of those businesses and startups. On slide 21, the risk market has got strong growth prospects across workers' compensation, injury management and ancillary risk management activities, and is less impacted by the insurance cycle. Austbrokers has acquired 4 key businesses since February 2014 under the owner-driver model, totalling $22 million initial acquisition payments to 30 June 2015, and we've announced one acquisition post-balance date, which was a 60% interest of Allied Health. On average, these risk services business deliver higher margins than our broking businesses. Complementary products and services provide value to clients and partners, the value of which will emerge in increased revenue from clients and flows between the risk services businesses and the broking businesses. Austbrokers adds value to these businesses via its broker network, but also importantly through the insurer relationships, which Mark has mentioned. The next slide represents our costs and our cost-to-income ratio. So this is group costs. It consists of holding company costs and costs of delivering services to our business where they're not recovered. So external costs are all fully recovered. However, internal costs in relation to developing products and solutions that are yet to be delivered to market are incurred and at this stage not recovered. I think what you can see here is the impact of having this discipline around keeping below a rolling 7-year average cost-to-income ratio. So that cost-to-income ratio has decreased from 22.9% back in FY12 to 20.6% in the current year as a rolling target, and our cost-to-income ratio this year was 18.9%. On the next page represents our balance sheet. So our balance sheet remains strong with limited gearing. Cash at hand has increased by $6.5 million and interest-bearing loans and borrowings by $12.2 million, largely driven by New Zealand. The net increase in net debt, that's net of cash, is under $6 million. Cash trust has remained stable. The impact of interest rates on our balance sheet is balanced across these cash and debt facilities. The main changes in the balance sheet are from this year's profits and the impact of acquisitions across intangibles and goodwill and investment in associates, and of course any changes to shareholdings and carrying values we've discussed. The return on equity before amortisation remains above our cost of equity. Moving on to the funding position. Consolidated debt of $66 million includes our subsidiaries' own facilities, and this includes $13 million New Zealand dollar facility that was drawn in February in support of those acquisitions in New Zealand. The group has undrawn facilities of $8 million with extended credit under discussion. Acquisition capacity from cash flow and current debt facilities is estimated at $26 million over the next 12 months, including for transactions announced since balance date. This estimate is based on not underwriting the dividend replacement plan. A low-growth environment is not a time for a lazy balance sheet, so we are choosing not to underwrite the DRP, despite a pretty active pipeline for acquisitions. We estimate we have capacity to increase this up to $54 million within an acceptable gearing ratio without raising equity if attractive opportunities that meet our criteria arise. Our committed future contingent consideration payments over the next 2 years is estimated at $28 million, and the majority are in the 17 financial year. On the following page, we set out the final dividend or dividend story since listing. The final dividend per share of 27.7 cents brings our full-year dividend to 39.7 cents, up 3.1% on prior year. It's fully franked and delivers a 5% dividend yield. The DRP remains in place for the final dividend, however, will not be underwritten, and the payout ratio on an adjusted basis is 67%. I'll now hand back to Mark, who'll cover the outlook.
Thanks, Jodie. So, FY16 outlook. So, it goes without saying, first point here, the commercial lines insurance outlook remains challenging. And what we've seen recently is a gradual easing in the premium rate environment. And while premium rates are expected to stabilise during this financial year in Australia and New Zealand, we believe premium growth is unlikely before the end of this financial year. From our point of view, drivers of revenue in risk services remain positive and are not impacted by the soft insurance cycle. We will continue to build on the strength of our business strategy, our core owner-driver business model, and to optimise our group operating model to be the leading insurance broking, specialist underwriting and risk services group. As our products and services mix continues to expand, this will enable growth across our business divisions, building value for our clients, our partners in Australia and New Zealand. In this financial year, the group expects continued organic growth, continuing the trend we've already seen in FY15, supplemented by executing relevant acquisition and startup investment opportunities across broking, agencies and risk services. The previous investments in strengthening the management team and building our core competencies will support the continued evolution of our operating model with the objective of underpinning long-term sustainable growth. We will continue to invest appropriately to ensure the continued development of our value proposition, ensuring we are highly relevant and attractive to future partners, staff and importantly clients. It is our objective to continue to contain costs below the rolling 7-year average. The result of all of this is the group is targeting growth in adjusted NPAT for this financial year of 5% over FY15, and clearly the achievement of this target is subject to prevailing economic conditions. At this point in time, I'd like to thank you for your attention, and we'll open it up for questions.
Thank you. And as a reminder to our audience, if you do wish to ask a question, you need to press 0 followed by 1. Once again, to ask a question, it's 0 followed by 1. And your first question will come from the line of Scott Olson from UBS. Please go ahead.
Morning, guys. Just a couple of questions. The first one on your comment around premium growth in 16 and that being unlikely. Is that referring to an expectation of further rate reductions, or are you just expecting a flat environment over 16? Obviously, we heard one of your peers yesterday say that they think it'll be reasonably flat over the year.
So to be clear there, Scott, and morning to you. A flat environment. As I said before, we've already seen evidence of easing, and this is something that we've been talking about since the half year when we originally came out with our indication. Remembering from our point of view, because all our brokers are on the same system, what we talk about is absolute fact that comes out of the broking system. What we've been seeing throughout the half year has been a gradually easing in the environment. It's still in negative territory, but we expect it to go flat throughout the year, through this year.
Okay, great. And then that kind of flows into a question on the guidance. Just from what you've disclosed so far on the acquisitions you've completed to date, it looks like those should add around 5 or 6% to growth in 16, and there were a few kind of costs associated with acquisitions incurred in 15 that I wouldn't expect to recur in 16. So I'm just wondering how that kind of reconciles to the guidance you've provided. Is there a little bit of further shrinkage factored in there, because you have referred to getting organic growth through the year?
I guess when you look at acquisitions, I would suggest you look at our returns based on the initial payments rather than I think you might be looking at the 70 million as opposed to something more in the order of 38 million that we have paid in initial payments, and that's the component that we would expect the hurdle rate returns on after tax. I think you'll also need to factor in a component of what's already been reflected in the current financial year. Yes, you're right in terms of acquisition costs and how they fall. There's also the matter of the contingent earn-out payments have funding costs on those. So whilst we haven't paid them, the balance sheet requires us to reflect those, and then there's these funding charges on those which have an impact as well. So I think you just need to take those extra things into account.
So one further point on that goes back to your previous point, Scott, as well. I mean, the premium rate environment is still negative. We're not flat yet. We're seeing the trending towards flat, so we'll still see a negative environment for, the next quarter or so, and then it'll go flat. That's our belief anyway, so that's been factored in.
Okay, great. Thank you.
Your next question will come from the line of Oscar Alba from Goldman Sachs. Please go ahead.
Hey, Oscar, you there?
Oh, it's Oscar from CLSA. Is that?
Yeah, hi, Oscar.
Can you guys hear me?
Yeah.
Hey guys, how you going? Yeah, look, the same sort of question as Scott. I just, just wanted to understand sort of the level of organic NPATA growth that you're sort of forecasting in FY16, just to see the buffer in your guidance. I mean, it feels like it's around sort of -2% to -3%. Is that sort of in the ballpark?
So I didn't quite understand your question there, Oscar.
Well, just looking at your guidance, obviously it's a similar question to Scott, but your guidance is talking about 5% NPATA growth. So after deducting sort of the acquisition contribution, are you sort of, is the sort of organic growth implied in your guidance around sort of -2%, -3% for FY16?
I think there's probably a couple of things, and maybe you will have heard the conversation we just had with Scott in terms of how you look at acquisitions and how they contribute. I guess the other things you need to have a look at are around profit commissions. So we've had really good contribution from profit commissions in broking and in underwriting agencies this year. When we look forward, we take a very conservative view on those. They are dependent on the profitability and performance, and they're not something that we sort of count on, if you like. And I guess, and I think Mark may have said in relation to our underwriting agencies business, there's a lot of organic growth that has come through there. We've had a good year this year, and it has been underpinned by some long-term contracts that we have with our insurers on good rates. But that level of growth into the future is probably, at those kind of levels we've seen over the last 2 years is not going to be sustainable for a larger business. So I think there's just a few things there that you need to factor in when you're looking at comparing those numbers to our target range.
Okay, thanks for that. And just look, finally on your cash flow conversion looked quite strong. Just wouldn't mind understanding the reason for that.
Which cash flow conversion are you talking about?
Just operating cash flow to NPATA. I think it was above 100%.
I guess it's going to, I don't have the details in front of me, but it'll just depend on the timing of dividends and timing of acquisitions and payments. So it's not very helpful.
All right, thanks for that.
On that one?
Yeah, that'd be great, thanks, if you don't mind.
Okay, we'll do that.
And your next question will come from the line of Nick Burgess. Please go ahead.
Yeah, morning, guys. Just dig into a bit of detail. Firstly, Jody, just on corporate costs, net corporate costs have grown 12% over the year. I guess for the next 12 months, are we expecting that sort of run rate to continue, or have a couple of projects finished and recruitment been finalised, so that might moderate a little bit? I'll ask my second question after that, sorry.
Yeah, sure. Look, we've been clear about how we manage costs and keeping it below our cost-to-income ratio on a rolling 7-year, and that's, I guess, the guidance you should take. In terms of, we have invested in the business. There is still, and Mark mentioned, in particular, general counsel role and that type of thing. That means that investment does continue there, but it's about how we manage that within our possibility.
Yeah, okay, I understand. Secondly, just on New Zealand, can you just remind us the New Zealand contribution for how many months and what the sort of annual sort of pro forma result or run rate is that we should be using as a starting point for forecasting next year? Or this year, sorry?
The business really only came on stream from, I think it was December, so really in the half year at the end of the day. So you've only got half year's worth of results. I can come back to you on a pro forma basis. We haven't prepared that at all. But effectively,
just presumably it's that it's fairly heavily second half weighted though. So
yes, it is. March is the year end though, yeah.
Right. Okay. Yeah. If you could get back to me on that'd be great. And Mark, while I've got you, just in terms of premium rates, I didn't see it in the presentation. What was your sort of experience in the second half in aggregate in terms of premium rates, and then just with your comments around expectations of that moderating and flattening, aside from what you're observing in your sort of systems at the moment, any sort of top-down sort of pieces of evidence or justification in terms of, reinsurance rates or underwriter behaviour that can add a little bit of meat to the bones in terms of an expectation of rates flattening out?
So this is the kind of you're going to get the common answer I give to everybody on this, because at the end of the day, as a broking organisation or one of the areas, we don't set the price. Fundamentally, we triangulate. So we have three pieces of evidence, if you like. So one is what comes out of our own production systems, i.e. what's really happening to rates in the marketplace on a same client, same period basis, and average that. Secondly is really the conversations that we have with the senior management of our insurer partners, and really asking about what their intention is in the marketplace. And again, what we hear is effectively that the market share game that's been played is basically been played out pretty much. So everyone's got their relevant market shares, and effectively people are back into keeping what they've already won position. The third part of that is if we think about, and I've been looking again through the insurer results and specifically extracting the commercial lines margin results for the insurers, and if you extract, for example, CG or IAG commercial, their insurance margin in commercials are, I believe, down to about 3%. So already the insurers themselves are going to have to do something to put margin back into this environment. So again, that would be our third, I suppose, evidential factor. In terms of what we saw through the fourth quarter, we did see, a gradual easing. I'm still in negative territory. I think June, as it always is a bit of a bun fight. We've seen a good improvement come through in our July data. And again, as we say, we monitor it every month. I'm quite happy updating on that basis because it is a live data. Our expectation would be that towards the middle of this year, I would hope to be in a flat premium environment.
Okay, that's helpful. Thanks very much.
Is that still Nick? Sorry, it's Jodie here. When you mentioned corporate expenses before, I think you might have said 12% growth. And if that's the case, the number that you're looking at is including corporate finance costs, which have obviously gone up as a result of acquisitions and that type of thing. So just if that's the line you were focused on, you.
Yeah, I mean, I read the question was really just getting to the fact that you've made some recruitment, and obviously you've sort of brought to close, I think, the iClose project. So really just wondering whether activity levels at that corporate level are going to continue with new projects, or whether that was sort of, in a general sense, just scaling down.
So this is Mark here. So effectively, at the true corporate level, the costs have only gone up 4%. It's only $500,000.
Yeah.
The funding cost of acquisition that drive it up. If you notice, I think it was on page whatever it was on the ASX or wherever it is. Table 1. That basically explains, because it's really driven by the corporate finance costs that then get kind of consolidated into net corporate expense. The controllable element that I'm interested in, that drives us, is what we invest in our core competence in the business, and basically we're holding that at about 4%.
Yeah. Okay. Great. Thanks very much.
And your next question will come from the line of Ray Toddson, who is a shareholder. Please go ahead.
Oh, first of all, thanks very much for letting shareholders actually participate in such things. I wish all companies would do that. There's a number of companies that you just get to listen and not ask any questions. So thanks for that. Got 3 questions, which I'll ask just one at a time if you don't mind. What's the impact, if any, that the arrival of Steadfast has had on the cost of buying into brokers? In other words, has it sort of pushed up the price or the cost of buying brokers, buying into them?
No, again, and I wouldn't just single out one competitor because there are a number of...
No, I know, sorry, yeah, but that's just an example, yeah.
I mean, effectively, what we're seeing is we saw a bit of a spike about a year and a half ago. We seem to be down to more normal range. I mean, it's depending on the size of the business, but you're looking at a range of somewhere between 6.5 and 7.5 times EBIT. Again, I can quote what goes on in the public domain. So we go out and talk about multiples. Our competitors go out there and talk about it. The last one that one of our competitors did was talking about 7 times. So we're basically in the range. And I think, again, as all of us are effectively listed companies and therefore have the interests of shareholders at heart, we have to ensure that we're providing a return to shareholders, an ROI.
Okay, thanks for that. The next one, and it's coming out of slide 24, where you're talking about costs, and I'm just wondering whether the figures that are on that slide of 26 to 54 million, is that the sort of cost that you're looking at or budgeted for to spend in FY16?
No, that's talking about our funding position. So it's the cash from operational activities that's available in excess of what we need to run the business, and therefore is available for future acquisitions or other investments. Okay, so
have you got a budget figure for acquisitions in FY16?
No.
No, we don't work it that way because basically everything's on a case-by-case basis. We don't set ourselves up because I think that would drive inappropriate behaviours within the organisation and would lead us to do things that maybe wouldn't be in the shareholders' interest.
Rightio, good, thanks. And just lastly, what's the target for income diversification away from broking? In other words, if you've got some idea of where the various segments would be in, say, 5 years' time?
Yeah, good question. The answer is no. The reason being is that we see this more like, it's a bit like a graphic equaliser. I mean, if we go back 5 years ago where predominantly all of our income or profit was generated out of broking, one thing I was particularly concerned about when I joined was that if you leave it in that situation, especially in a very soft premium environment where we don't control the price, and therefore when, 63, 65% of your income is in broking is coming off commission, and on a falling tide all boats go down, i.e. if the rate is down there, if your commission income's going down, you're wholly reliant on that's a difficult place to be. So this all comes back to the concept. We link it back to our strategy. It's very client-focused. It's about the whole concept of providing total risk management solutions for clients who are predominantly businesses, SME and mid-market. And within that, if we can provide capabilities around risk assessment, risk solutions and post-event solutions from within the group or from without as well, we're equally happy with that. But what that basically lets us do is to ensure that these business areas, as we're investing in, for example, risk services that provide services to brokers, they provide services to the insurer partners, also to direct to big clients as well. But as that income increases over time, it helps, and it's not relevant to the insurance cycle. It helps mitigate against some of the historic weight that we've placed on broking income. So we don't put a target to it. It's more about what is right in terms of our strategy. But clearly it's a focus because we don't want to be wholly reliant on broking income.
Rightio, thanks.
And just as a final reminder, if you do wish to ask a question, it's 0 followed by 1. Your next question will come from the line of Jim Godsall from Goldman Sachs. Please go ahead.
Good morning. I saw you highlighted that you'd commenced offshoring some of the operations in the underwriting agencies business. Is there any chance you'd consider a similar exercise for the general broking businesses?
Absolutely. I mean, again, from our point of view, what we're looking at doing, this is a good test for us to work out what are the capabilities that we can source offshore. Now, the only reason we would do that if it's a more cost-efficient way of doing things, but it doesn't impact the client or the broking experience. So, we're not putting. It's an area that we're kind of focused on, and if we think about it, we've already got some of our partners who are already doing this. For example, MGA, the large South Australian-based broking organisation, is already doing some of this. But from a group perspective, it is something that we're going into. We can see the benefits where they will be ascribed, and equally, if we can then utilise and expand that to provide benefit to our partners, then that's something we'll do.
Okay. And the $1.5 million impairment that you highlighted was due to competition in a niche area. Are you able to say what area that was in?
It's a fairly specific area in the broking space. I don't want to go into it too much detail. The reason being because it would there's a specific entity that, again, it would reveal and under confidentiality and basically, I suppose, allegiance to our partner. I'm not going to go into the specific sector, but it is something that's been but it is something that has been affecting that broker. Importantly, though, it's an economic factor in the sector. That broker has retained their client count. It's just that there's been a competitor come in and they've had to compete against it at far lower rates. So it's one of those things that wasn't foreseen when we originally acquired the organisation, but effectively has affected it. It's still a very good organisation.
Yeah, and I guess another way of asking the question: do you have any other brokers that operate in that sphere or in that niche?
Not specifically, no.
Okay. And just one bit of housekeeping. The $26 million of available funding capacity you've quoted for FY16, you'll have to excuse my misunderstanding. Is that before or after incorporating the amount you've spent on the Allied Health acquisition?
It is before Allied Health, so it's at balance day.
Yep. Okay, great. Thanks very much.
And at this time, there are no further questions in queue.
Okay, so I'd like to thank everyone for coming on the call. Equally, one thing I failed to do was actually to thank our partners, our staff, and our clients as well for their support during this year, and we look forward to ongoing partnership and growth in coming years. So thanks very much, and we look forward to meeting a number of you in the ensuing one-to-ones coming up. Thanks very much.
Ladies and gentlemen, that does conclude our call for today. Thank you all for participating. You may now disconnect.